Crypto trading strategy in the midst of downtrend storm. Survive and profit. Hello everyone. Welcome back to Mr. Suw Crypto, the hangout of market warriors who are still hanging in there. Even though their wallets are red, their hearts are broken, but their brains are still sane. In this episode, we'll be discussing a topic that is poignant but very important, namely how to trade crypto smartly in the midst of a downtrend storm. Because let's be honest, a red market doesn't mean the opportunities are gone. This is precisely where disciplined traders can get a head start before the bull run comes. So, for those of you who are already upset, want to slam your phone, or almost uninstall the exchange app, hold on. We'll go through the strategies one by one, from shorting, spot trading, hunting against the grain, to emotional management. Just relax, put on your headset, sit comfortably, and prepare a cool mindset. Let's get started. Chapter 1. Shorting, the ultimate weapon in a stormy market. Okay, now imagine you're on a sailboat, and suddenly a tornado comes from every direction. Well, that's it, the crypto market situation during a downtrend. The coins are in free fall, FOMO turns into FUD, and the entire X, formerly Twitter, timeline is just one. Captain, we're sinking. But calm down. For traders with a cool head and a sharp strategy, this is not the end of the game. Instead, it's the beginning of survival mode, and one of the weapons you'll need to master is shorting. What is shorting and why is it important? Shorting is like betting that the price will go down. It's like saying, bro, the price of Bitcoin seems to be going down. And if your guess is right, boom, you profit. It's usually done on derivatives markets like Binance Futures, Bybit, or OKX. You can open a short BTC/USDT or ETH/USDT position, meaning you sell first at a high price and buy back later when the price drops. The profit? From the price difference. To put it simply, spot market equals buy low, sell high. Shorting equals sell high first, buy low later. Illegal? No, it's not. It's a legal and common strategy. Even big institutions often use it to protect their assets. Shorting for hedging, not gambling. Now, this is important. Many beginners think that shorting is for instant cash, when in fact it can be a hedge for your spot portfolio. For example, you have 10 units of ETH in spot, but your gut feeling or your indicator signals tell you ETH is going down because BTC just broke $60,000 support. Well, you can open a short position of 10 ETH in futures. So if ETH does go down, your spot value is a loss, but your short position is a gain. Your spot loss can be covered by the futures profit. It's like when you're on a boat, you wear an extra life vest. If the ship leaks, you're still floating. But remember, don't be greedy. Shorting is as sharp as a kitchen knife. In the hands of a chef, it can make sashimi. In the hands of a panicked person, you can cut yourself. That's why. 1. Leverage small. Maximum 5x, or safer at 3x. Don't be chased by margin calls like an X. 2. Always use stop loss. The crypto market can go in the opposite direction in a matter of seconds. Without stop loss, get ready to liquid. 3. Don't go full margin. Leave a reserve fund. Remember, survival capital equals next opportunity. Shorting without knowledge equals financial suicide. Many novice traders enter shorting just because they see Twitter saying, $DOG will crash. Immediately all in. Hey, it turns out that Doge went up because Elon posted a new meme. Boom. Liquid. Shorting requires data, valid technical analysis, and an understanding of macro trends. At a minimum, look at moving averages, MA 200/MA 50. Check the breakdown breakout volume. Look at support resistance zones. And if possible, monitor macro news, like the Fed's interest rates or crypto regulation news from the SEC. Sometimes one sentence from Jerome Powell can blow the market away like a cracker with steam. When is the best time to short? Not all the time, but when Bitcoin breaks down from important support, e.g. from $60,000 to $58,000. Altcoins start to retrace after a pump with no volume. There is a big FUD, like exchanges going bankrupt, stablecoins depeg, etc. Signals from the chart show bearish divergence. And if you see a small market bounce, but weak volume, be careful, it's often a Batman trap, suitable for thin short entry with tight SL. Not just making a profit, but surviving. Shorting is not about getting rich overnight. but to survive and keep your assets intact when the market is brutal. Remember, in crypto, survivors in the downtrend phase are usually winners in the next bull run phase. So, practice your shorting skills, but not for fun, not to hit the jackpot. Use them wisely, like a ninja who knows when to attack and when to retreat elegantly. Chapter 2, Spot Trading in Downtrend. Don't be weak, don't hesitate, take profit first. Alright brosis, now we discuss the fate of spot warriors. Yes, those of you who don't like futures because it's complicated, or maybe you're still traumatized by liquid because you clicked the wrong cross-leverage 50x button. Well, spot trading is like fishing in a river where the current is very strong. Can you catch fish? You can. But if you hold the rod too long, well, the fish runs away and the hook gets stuck. That's the main challenge of spot trading in a downtrend market. The market is sluggish, global sentiment is dark, and most coins have a small rally and then drop again. But that doesn't mean we can just sit there and do nothing. There are strategies to keep you harvesting, even if the market is like a graveyard at 3 a.m. Rally in downtrend is a trick, not a wedding invitation. Here it is. In the middle of a downtrend, there is usually a relief rally, aka a temporary increase that makes the heart happy and the wallet hopeful. Example, BTC suddenly rises 10% in a day. ETH jumps into altcoins. They follow suit, pretending to be bullish. But unfortunately, it's often a trap. The increase is only a lifetime. Before you can take profit, the price has plummeted again. That's why, in phases like this, take profit must be fast and aggressive. Don't be pretentious. Don't be diamond hands. The market is not testing your patience. It is giving you an exit before the ship sinks. Practical strategies for spot traders in the dark phase of the market. Okay, here are the tips, real applicable. 1. Set small targets. Take fast. Do you usually aim for 20 to 30% profit? In a downtrend, targeting 5 to 8% is a luxury. Get 7%. Sell some of the gas. It's like eating bread now instead of waiting for a party, but instead fasting for a week. 2. Use alert and auto sell. Many traders are trapped because they wait for feeling signals, even though feelings are often wrong. Install alerts in TradingView. Use limit orders to auto sell at the target. Discipline is key, not feeling. 3. Do not average down arbitrarily. Bearish markets are sneaky. The more you buy on the dips, sometimes you're just flashing the falling knife. If you buy Dollarmatic at 90 cents, then it drops to 70 cents, and you think, this is a discount. That could be just the beginning. So instead of blindly averaging down, wait for a reversal signal or look for volume confirmation first. 4. Sell gradually, don't take one off. Take the scaling out technique. Sell 30% first, then 40% if it goes up a little more, and the rest if the market really confirms a reversal. This is to avoid regret. Why didn't I sell when I was already profitable? Ideal conditions for spot scalping in downtrend. If you like spot scalping, pay attention to moments like BTC or ETH bounces off strong support, e.g. BTC bounces off $58,000 with huge volume. There was a brief positive news, a spot ETF is passed, a country adopts crypto, or a major exchange lists a new coin. Asian markets open and volume rises. This often provides a mini bounce. Scalping is possible, but be prepared. Don't expect big swings. Focus on finding small but safe profits. Common spot trader mistakes in a bad market. It's just a small correction. It's a correction within a correction. In a downtrend, a small rally is not a strong signal, it's just wave froth. It's awkward to sell now. It's better to wait for break even. Nope. The market doesn't care if your position is stuck or not. If the bearish signal is getting stronger, getting out quickly is a smart move. Look at that guy holding on. Can I hold? Remember, every trader is different. Maybe Mr. A bought ETH at $200, while you bought it at $3,000. Don't use other people's strategies for your portfolio. Be a fast harvesting farmer, not a loss collector. Downtrend is not the time to be a coin collector. It's time to become a fast food farmer. Plant, nurture, harvest, get out. Spot trading in this phase is like a survival game. Those who are quick to take profits are the ones who survive. And if you consistently take small but regular profits, a small profit locked in is much better than a big dream that keeps getting stuck. So brosis, Learning to take profit in the spot market is not a sign of weakness. It's a sign that you understand the terrain, know when to walk, and when to step aside. Chapter 3. Long the Anomaly. A strategy to outsmart the bearish market with resilient coins. Okay, now let's talk about a strategy that can be considered semi-wrong but full of logic. Long coins that are strange but resilient. In the midst of a red storm, there must be one or two coins that resist. All altcoins are down. There is one that is even 12% green. Others are sad. He is even relaxing having coffee. This is what we call an anomaly. A coin that rises even though the market is bearish. And if you can find a coin like this early, well, it's like finding a lightning-proof umbrella during a storm. Why can a coin rise when the market crashes? Here's the thing. When the market is gloomy, most people only see BTC or ETH. But behind the scenes, there are coins that are playing themselves. They don't really care about market conditions because they have a strong catalyst. What is a catalyst? It's an internal or external driving factor that keeps the coin interesting. Some types of catalysts that often become triggers. 1. New listings, new coin, new hype. You must have seen this pattern already. New coin listings on Binance, Bybit, OKX, boom. The price immediately explodes, even if the market is flat or even bearish. Real example, $TIA when it was first listed on Binance. $SAGA when it first appeared. The airdrop coin that immediately got a big trading pair. Why is that? Because there was sudden demand, high volume, and FOMO. There weren't many holders yet, so the supply was clean. But be careful. This type of coin goes up fast, goes down fast too. Must be observant, must be fast. Scalp the pump, don't marry the hype. 2. Hot narrative. Coins that are the big story. In the crypto world, story is everything. Narrative has crazy power. The market can go down, but if your coin's narrative is a trending topic, it can stay green. Some examples of narratives that are still hot despite the market shake. AI coins, like $FET, $RNDR, $TEO, because the world loves AI. RWA, real-world asset like $ONDO, bringing the story of bridging the real world to blockchain. Layer 2, coins like $ZK, $SDRK, $OP keep an eye on because they have a future of scalability. Res taking and LRT, coins like $FI, $REZ, or $RSP based on liquid staking narratives are getting hype. The point is, as long as there is a big relevant story, the coin can resist collapse, at least be more resilient. 3. Event-driven, real action, not just white paper promises. Network upgrade, token burn, hard fork, mainnet launch. These are events that can make a coin live when others are sleeping. Example, $BNB routinely burns every quarter, and the effect often causes a mini pump. Ethereum Dinkin upgrade made ETH and L2 ecosystem rise together. Cardano, Avalanche, Solana sometimes rise ahead of a hard fork or EVM compatibility upgrade. The strategy? Monitor the event calendar via CoinMarketCal, and don't be lazy to read official project updates. Remember, buy the rumor, sell the news, but make sure the rumor has content. How to execute? Don't just go long. Use this checklist. Want to go long coin anomaly? Check first. There is a clear catalyst, not just Telegram gossip. Volume rises 2-3x from the daily average. Price is still near support, so that stop loss is not far away. Active community sentiment can be checked on X, Twitter, Discord, or Telegram. If 3 of these 4 checklists pass, gas. But remember, use small sizes. Always use stop loss. Target quick money, don't marry coin hype. Real examples in 2024 to 2025. Let's not go too far. $ONDO. Although BTC is red, ONDO often rebounds due to many large VCs and narrative RWA. $FET and $TAO. AI narrative makes this coin often go up even though the market drops. $PYTH and $JUP in the Solana ecosystem also often make surprises. And of course, the new listing coins that not many holders have caught. It can be a fast scalping field. The market may be shaky, but the brain must be sharp. When the market is red, it doesn't mean all opportunities are closed. Instead, this is the time for you to train your instincts. Coin anomaly is like a super fish in a deserted lake. It's hard to find, but if you find it, the results are extraordinary. But remember, don't overtrade. Don't FOMO. Focus on logic, not hope. Chapter 4, Size Down. It's not about losing. It's about staying in the game. Okay, we've talked about shorting, quick spot strategies, and looking for anomaly coins that can jump when the market is dying. But now, we go to the most underrated, most underestimated, but secretly the most survivable strategy. Size down. For those of you who aren't familiar, size down means reducing the size of your position in each entry. Usually enter $1,000 at a time. Reduce it to just $300 to $500. Why? Because in an unhealthy market, playing big is like asking for a fight when you have a fever. Downtrend equals survival mode. The market is falling. Red candles are a daily sight. BTC is dropping below support. Altcoins are like a zombie parade. This is not the time to show off. This is not the time to be a true Deegan who spreads nets everywhere. This is not the time to go all in because of a good feeling. This is the time to survive. If you can survive the next 3 to 4 months, your capital is still intact, you are still mentally sane, and your account is not liquid. You've won 70%. Why size down? Here's why. 1. Lower risk per trade. The smaller your position, the smaller the loss when the market goes against you. If you usually lose $200 on one position, with a small size you might only lose $40. And that makes psychology more stable. 2. Uncertain market equals don't be overconfident. In a downtrend, support often breaks down like a storm door. Fake breakouts are everywhere. What was said to be a bottom actually continues down. So if you play full size in conditions like this, your mentality will be chewed up. 3. Have spare bullets. With a small size, you still have capital for averaging down if the price touches the extreme zone. Example, you buy $REZ at $0.045 with $300. It turns out that the market landslides, and REZ falls to $0.032. Since you didn't go full size from the start, you still have ammunition to buy below. Finally, your average buy is lower. 4. More disciplined, sharper. Small size makes you think more before entering a position. Every trade becomes more planned, more strategic. Because you can't just hit it. You have to be really sure. Real example. Let's say you have a $5,000 portfolio. Usually you enter $1,000 per coin. During a downtrend, lower it to $300 to $400 per position. This means you have plenty of breath. If you make a mistake, you don't get crushed right away. If you're right, you'll still make money, even if it's not huge. This kind of strategy is what makes senior traders durable. They've been through 2018, 2020, 2022, and they're still alive because they know when to gas, when to brake. But what if you miss the rally? Brew. In a downtrend, the rally is fake sweet. Going up 10%, then dropping 20% is normal. So it's better if you miss a little, but your capital remains intact. Instead of jumping in when the candle is green, you'll get rug pulled. If indeed the market has confirmed a bullish reversal, there will be plenty of time to board the ship. Remember, it's better to enter late than to exit broke. Size down tips. Set the risk per trade to 1 to 2% of the total portfolio. If in doubt, enter partial entry first, e.g. 30%, then increase if the setup is valid. Avoid averaging down too early. Wait for significant support. Prioritize liquid and fundamentally relevant coins. Don't get stuck on MySyn coins whose devs have moved on to other projects. Smaller, safer, longer breath. The crypto market is not always about big jackpots. Sometimes, the coolest person is not the one with 10x profit, but the one who can say, I survived 3 bear markets, and my capital is still intact. Size down is not a sign of weakness. It's a sign that you're a smart trader. You know when to move forward and when to stay down. Chapter 5, Emotion Management and Extra Research, when the brain and heart need to get along. We've talked about techniques, shorting, spot strategy, looking for coin anomalies, and size down. But all strategies are useless if your brain is stuck and your heart is panicking. This last chapter discusses the most underrated weapon, deep research and stable emotions. 1. Research is a compass, not a forecast. Many people think that research is for guessing prices, but its main function is to understand the context. Why did coin A go down? Why is coin B resilient? Real-life example. You hold $ONDO. When the market is red, it goes up. Why? Because it carries the narrative of real-world assets, RWA, which is being fried by institutions. With enough research, you can hold more calmly, take profit more appropriately, not easily FOMO other coins. Research sources that you must monitor: Cointelegraph and CoinDesk for big news, ETFs, regulations, etc. The Block, insights and technicals. X, Twitter, check out on-chain analysts like Willy Woo, Lucanchain, or Defy squads. Discord/Telegram project ***. Keep up to date with roadmaps, upgrades, and internal news. Remember, fundamentals are slow but powerful. While technicals can be wrong, fundamentals often justify it in the medium term. 2. Emotions equals traders' number one enemy. We are not robots. When the market drops, it's normal to panic. When the market pumps, it's normal to be greedy. But here's the thing. If your trading decisions are made in an emotional state, they're 90% likely to be wrong. Classic example. BTC breaks $58,000. You panic, cut loss. 2 days later it bounces to $63,000. Finally, you FOMO buy again. 2 days later, BTC goes back to $59,000. In the end, you lost not because of the wrong strategy, but because emotions messed up the execution. Tips to keep your emotions in the middle of a crazy market. Set a plan, write it down in a journal. Enter at what price, take profit where, cut loss where. If the market is shaky, just reread the plan. Do not improvise impromptu. Set alerts, not watch the chart. Use alerts on TradingView or exchange apps. Don't torture yourself to open the chart every 5 minutes. It will make your stress rise and your mind dull. Don't be alone. Join a community of sane traders. Not a group that goes to the moon every day. Find one that can have realistic discussions. There you can learn to slow down. Fight greed with logic. You can get 8% profit in the middle of a falling market is an achievement. Don't compare it to a bull market. A 5% profit in a red market is like 20% in a bull market. 3. Cut loss is not a disgrace, it's survival mode. This is the point most traders' egos reject. But the fact is, traders who can cut losses calmly are the most durable traders. Let's see. You bought a coin at $1, and now it's at 75 cents. Are you sure that's a bottom? If you're wrong, it could go to 50 cents, even 30 cents. If you cut loss now, you lose 25%. If you wait, hopefully it will go up again, and it turns out to be down 60%. Hope equals trap. Cutting loss is like amputating a wound before the infection spreads. It hurts, but it saves. The market may be wild. You must stay calm. Downtrend is not the end of the world. It's part of the cycle. What's important is not that your profits are high, but that you're there when the cycle turns into a bull market. With a disciplined strategy, sharp research, and controlled emotions, you'll not only survive, but be ready to explode when the time comes. Okay, that's it for this episode. Strategies to survive and profit when downtrend hits. Remember, in the crypto world, it's not the geniuses or the aggressive ones who survive. It's the disciplined ones who can think clearly during market chaos. Don't rush to get rich. Rush to understand first. Because understanding makes you resilient, and resilience makes you profitable. If you like this kind of educational chat style, don't forget to share this podcast with your friends who are also flooded with floating losses. Don't forget to comment next we discuss what else. See you in the next episode. And remember, wallet may be thin, but don't be mentally destroyed. Peace out, and may the market favor us this week. Disclaimer: this content is educational, not financial advice. Crypto trading is high risk. Evaluate your risk profile before taking action. Okay, before we end, don't forget our golden rules. 5 important rules of Mr. Suw Crypto. First, don't use hot money. Use extra or idle money. Do not use money for daily needs or money that will be used in the near future. Second, don't over-leverage. Risk what you can afford to lose if you trade derivatives, futures. Always use a stop loss because the crypto market is very volatile. Third, 70 Bitcoin 30 altcoin. Always allocate more in Bitcoin because Bitcoin is the parent of crypto. By allocating more in Bitcoin, your portfolio will be safer when the market does not meet expectations. Fourth, always stay cash. Always stay in cash 10 to 20 to buy when the market discounts or drops significantly. Then you can sell when the price has risen, so that you still have cash for the next discount. Fifth, think long-term. Investing is not about 1 or 2 days to get rich. So think long-term and minimize the risks that might make your money disappear. Everything takes time. Remember, Warren Buffett didn't build his fortune overnight. If you find this video useful, help us to continue to make videos like this by clicking subscribe and share with your family and friends. Don't forget to let us know in the comments column if there is anything you have questions about, because your comments mean a lot to build this channel. See you soon, and don't forget, HODL knowledge and mindset first, then HODL assets.